Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, and my name is Daddy. I'm also Uncle Travie. I'm like SpongeBob. I gotta flip a patty. You better back off. You better not grab me. All the ladies need to know they can't have me because I'm a daddy and I'm Shara Spencer's bacon, and that is for all the fathers. Happy Father's Day, y'all.
Let's get bonkers!
That was so weak, and you guys, we rehearsed that 10 different times. Happy Father's Day to all the fathers. It is an absolute blessing to be a father. But today I'm taking you to the blueberry field one more time because today is the last day before it closes for the entire year. And today we're going to talk about credit tightening and whether or not it's really here. And then I'm going to show you guys how loose credit was back in 2006 and 2007, so people start understanding what is really happening in this housing market. And y'all, what's happening in the housing market right now is absolutely bonkers. And we're going to read a Mortgage Bankers Association article titled "Mortgage Credit Availability Decreased in May." Although I've recently got out of origination, one of the ways I was actually able to make a reputation for myself, because I never believed in begging realtors for business, which is what most loan officers do. I wanted to make a reputation on essentially being able to close the really hard, challenging loans. And then the advantage of doing that, y'all, is I was able to really learn how underwriting works, specifically automated underwriting through Loan Prospector and Desktop Underwriter. And those are systems that loan officers use and also underwriters use to actually approve and close loans. So it's really important as a loan officer, or really anyone in the mortgage industry, to understand how credit tightening and underwriting really works. So really what I'm trying to say is, even though I'm not actively originating right now, you guys, being that I work for a mortgage lender or home loan lender, Amcap Mortgage, it gives me a special ability to give you guys boots on the ground intel as far as any immediate and drastic credit tightening changes. As you can see, we get these buckets right here. I had to, what's up, Sophie? What's up, girl? You gonna get some blueberries? Anyways, we fill these buckets up and then we take that home and we make like blueberry cobblers and pies and stuff like that, right, Soph? Yeah. Now go get some, girl. Anyways, super fun thing to do with your family. I really strongly suggest anyone stressing, you know, about the housing market or whatever in life, go out, take your family somewhere early in the morning, get up early, collect some blueberries. The point I'm trying to make is even though my channel is all about real estate, your life doesn't have to be. So go enjoy it. Now let's jump into the article. Mortgage credit availability decreased in May, according to the Mortgage Credit Availability Index, or MCAI, a report from the Mortgage Bankers Association, or MBA, that analyzes data from ICE Mortgage Technology. The MCAI fell by 3.1% to 96.5 in May. A decline in the MCAI indicates that lending standards are tightening, while increases in the index are indicative of loosening credit. The index was benchmarked to 100 in March 2012. The conventional MCAI decreased 2.3%. The government MCAI, or FHA, VA, USDA, decreased by 3.8%. One of the component indicators of the conventional MCAI, the jumbo MCAI, decreased by 1.5%, and the conforming MCAI fell by 3.9%. So month over month, this data is saying a decline, but 3%, I mean, seriously, that's not going to do very much at all. And honestly, those declines in those charts may actually be from the unaffordability and not necessarily the credit tightening, because as things get more unaffordable, it's harder to get credit, because being able to pay back the loan is obviously a qualifying factor when it comes to getting a loan. Now, we've heard from Jerome Powell that they want to skip the interest rate hikes so they can continue to see credit tightening play out. But my question to y'all is this: had they not started quantitative easing, and had they not bailed out the banks, right, which they did in roughly March, roughly about $400 billion, if they wouldn't have bailed out those banks, wouldn't credit tightening be much worse right now? Doesn't injecting $400 billion into the banking and financial system actually loosen up credit? Do y'all see what I'm saying? Things would have been much worse if they would have just let the lenders fail. Essentially what we see here is the Fed fighting the Fed. This has been a little bit difficult to call because the data is all over the place, and what the Federal Reserve is saying and Jerome Powell is saying is also all over the place. On one minute, they're worried about rents and inventory in the housing market, and the next minute, Jerome Powell is saying he's not worried at all, not even answering any direct questions. But regardless, the data is suggesting mild credit tightening happening. All right, so y'all can see the path is labeled there. I'm not gonna get lost like I did last time. Just wanted y'all to know that. So let me dig back into this article. Let's read a little bit more. Mortgage credit availability decreased for the third consecutive month as the industry continued to see more consolidation and reduced capacity as a result of the tougher market. While this decline in availability, the MCAI is now at the lowest level since January of 2023. And you guys, we wanted it at the levels of 2013. The conforming index decreased almost 4% to the lowest level in history of the survey, which dates back to 2011. Jumbo index fell by 1.5% last month, its first contraction in 3 months, as some depositories assess the impact of recent deposit outflows and reduced their appetite for jumbo loans. Additionally, lenders pulled back on loan offerings for higher LTV and lower credit score loans, even as loan applications continue to run well behind last year's pace. Both conventional and government saw declines last month, and the government index fell by 3.8% to the lowest level since 2013, in a market where a significant share of demand is expected to come from first-time home buyers. The depressed supply of government credit is particularly significant. Okay, so even though it was only a 3% decline month over month, at least that's 3 consecutive months, and at least certain types of loans are at 2013 levels. And obviously, guys, we want that way worse, because we really need to kind of stranglehold lending and kind of cut that off, because there's still so much buying going on right now. So here's what else is happening. Even though they're saying the credit is tightening and things like that, lenders are also pushing for more risky and toxic financing. And that's why you guys see the 1% assistance programs, because there will be lenders that actually try to loosen up what they're offering to consumers so that they get some of that market share. So it's kind of like you got two things going on. You got lenders that want to lend even more money to stay in business, and then yet you have these other lenders that probably got burned somehow on these bank runs. But most lenders, residential lenders, are not depository institutions. Most mortgage lenders are like regional lenders. They borrow money and then they sell the money and then they borrow it, but very few of them actually keep the loans and service them. Y'all, it's crazy how humid and hot it is right now. It's not even 8 o'clock. Houston, Texas, I do love it here. It's next to the ocean, but I definitely hate the humidity. But let's put this in perspective. I'm gonna throw up a chart that actually goes back to about 2011. Unfortunately, it's not going to 2002, but take a look at this chart. Now, what you see here is the Mortgage Credit Availability Index. Now, it is the lowest it's been since 2013. And I want you to notice that actually around 2013 is when mortgage availability really started spiraling out of control, and it peaked at around the lockdowns, around 2020. It peaked, kind of plateaued, as you can see there, and then went down. So again, although we're not seeing like, you know, really guidelines, like hard factual guidelines change, which is really what we need actual like hard guidelines change, at least according to this data, there is certain things happening. Now, it's not happening very fast, but hopefully it will happen fast enough to curve the spring and summer buying demand. And that's what we're actually seeing right now in the housing market. We're seeing the seasonality basically stronger than the unaffordability, y'all, and the lack of supply. Obviously, the numbers appear to be a lot stronger than what they actually are. The numbers are so strong because there are such few transactions. Well, my family just informed me, y'all, that the blueberries today, well, it is the last day, are slim pickings right now, unlike the loans that are in the market right now and still available for people, because lenders want to lend you money so that they stay in business. That's fair, right? Let's look at the overall different types of loans and see how credit tightening has actually changed over the last 10-15 years. Now, as you can see here, the most noticeable change was conventional, jumbo, and actually also conforming loan, whereas if you see in the upper right, the government actually had much smaller volatility, right? Volatility trends. It was more gradual than the other ones. It's also fair to say that the government, if they chose to, can literally turn off the housing market right now in the form of like FHA, USDA, and loans like that. And if they did that, y'all, I believe that would help our housing market significantly. Obviously, it would help curve demand. But I'm telling you guys right now, at least this year, credit tightening, the unaffordability, the lack of supply isn't enough to get our housing market back. Now it may have been had it not been for that additional $400 billion. And again, that money was injected into the finance system. And when it's injected and it starts in the finance system, obviously that spreads to other sectors in our economy. For example, now that those lenders got $400 billion, they can continue to do what? Lend money and stay in business and keep the people employed. And when they lend money, the people that they're lending money to are going to use that money to probably grow. So in other words, what I'm saying, you guys, on one hand, they're like, yeah, the credit tightening is going to happen. The credit tightening is going to happen. But on the other hand, they just gave lenders $400 billion. The conventional, government, conforming, and jumbo MCAIs are constructed using the same methodology of the total MCAI and are designed to show relative credit risk/availability for the respective index. The primary difference between the total MCAI and the component indicators are the population of loan programs which they examine. The government MCAIs examine FHA, VA, and USDA loan programs, while the conventional MCAI examines non-government loan programs. The jumbo conforming MCAIs are the subset of the conventional MCAIs and do not include FHA, VA, or USDA loan offerings. The jumbo MCAI examines conventional programs outside conforming loan limits, while conforming MCAIs examine conventional loan programs that fall under conforming loan limits. Basically, y'all, that's just a whole bunch of jargon. It makes perfect sense to me because I've been in the industry. You guys could see how my shirt is, I mean, y'all, again, it's like barely 8 o'clock right now, and I'm like dying out here with the humidity. You guys aren't gonna get too many boots on the ground videos in Texas during the summer because I am melting right before your eyes. We still don't have enough credit tightening to make an impact. And again, what I'm also saying is the numbers are this way because unaffordability, when unaffordability is this out of control, really almost historical, it's gonna limit lending. Am I wrong here? You guys comment below. Let me know if you guys think it's possible that it appears that there's credit tightening just because of the higher rates, when the reality is credit actually may be loosening. I just found a bush that has a few blueberries left. Just to give you guys an idea of how many people have been here. Look at how bare this is. I mean, you can't even see barely any blueberries. You got some right there. Those are good ones. You got some up there, but look it, that's it. They have literally plucked this bush dry, just like they have with home equity, and that's why we're saying home equity essentially plateau, although people are saying there is a massive rebound. Now, there has been a rebound, but still, almost everyone that purchased in the last 2 years is upside down in their house. If you consider the fact if they have to move, they pay an additional 8%. Now, the cool thing about this chart is it actually goes back all the way to 2004. So now we kind of have our comparison to really, guys, see how loose credit was back in 2008. And I've been trying to make this point with several people. I was a successful loan officer back in 2002 to 2008. And I constantly tell people the loans right now are so much different in the sense that the verification of income is still overwhelming. Whereas before you could just state your income, you didn't have to prove it. And you can see that here in the chart. Now look at what happened. Basically, when the subprime collapse happened, the Dodd-Frank Wall Street Reform Act, it went plummeting downwards. So as far as credit availability, you really can't compare right now to 2008 as far as guidelines. But what's worse, you guys, unaffordability and equity run-up is much worse than the last financial collapse. So even though credit is tighter, unaffordability is not, which I think is making things a lot more sticky. But let me read this up here. The total MCAI has an expanded historical series that gives perspective on credit availability going back approximately 10 years. The expanded historical series covers 2004 through 2010 and was created to provide historical context to the current series by showing how credit availability has changed over the last 10 years, including the housing crisis and ensuing recession. Data prior to March 31st, 2011 was generated using less frequent and less complete data measured at 6-month intervals. Methodology on expanding historical series from 2004 to 2010 has not been updated. But again, I really think it's important to pay attention to that chart. I hear a lot of comments saying that the loans right now are just as bad as before. It's important to know that that's not the case. Loans are way more strict right now because of the income verification. But again, what I'm saying is what is way worse, overwhelming unaffordability and overwhelming equity run up. That is way worse than 2008. Look at those blueberries, y'all. So I can still pick blueberries and do this report at the same time. Here you go, honey. You guys, we are short on blueberries. We have not collected enough blueberries to make a difference in the blueberry pie, just like we have not collected enough inventory to make balance in the housing market. But let me finish this article out. About the Mortgage Credit Availability Index, the MCAI provides the only standardized quantitative index that is solely focused on mortgage credit. So if y'all want to follow credit tightening, this is probably the index that you want to watch. The MCAI is calculated using several factors related to borrower eligibility, which is credit score, loan type, loan-to-value ratios, etc. These matrix and underwriting criteria for over 95 lenders and investors are combined by MBA using data made available via ICE mortgage technology and a proprietary formula derived from MBA to calculate the MCAI, a summary measure which indicates the availability of mortgage credit at a point in time. So really, other than the boots on the ground intel from industry professionals, this is really the only matrix that we can watch to kind of determine whether or not credit tightening is happening. Now, in conclusion, here's what I want to say. Prepare, okay? So right now we should be increasing our credit, we should be increasing our FICO score so that as credit continues to tighten, we are safe because we've put ourselves in a situation to where we can handle these hits that we're taking. And that's what I keep trying to tell you guys. And that's what I'm doing. We need to prepare for the first hit, whether it's job loss, credit tightening, things like that. Because if we don't prepare for these things, if we don't prepare for credit tightening by increasing our purchasing power, then we could potentially become a victim ourselves and be blindsided. So in the meantime, again, work on credit. What's the best way to do that? Typically making sure your credit cards have super low utilization ratio, which you never want to exceed roughly 30% of your credit lines. And the higher your credit score is right now, and the better your credit score is, the better ability we'll have to get financing when potentially they shut it down completely and it plummets even more. So, in other words, preparation is key. And that's actually what luck is. Luck is preparation and opportunity. So I hope y'all, you get lucky. But it also takes effort and it also takes work. Now, other than that, guys, I really hope you enjoyed this video. I'm dying out here. We're gonna get everything wrapped up, go home, probably go to like Sam's Club or something like that, prepare to go to the beach. But I really just wanna say, if you're frustrated, hang on, you guys. Things always change. Nothing is forever. We should know that. Just like the unaffordability right now, it will eventually change. And if you do have to buy right now, just be properly prepared. I don't think you should. I've told you many reasons why, but if you are, at least be aware, at least be prepared, because you will be better off. Now, other than that, guys, I really appreciate you following along this journey. And if you're out there investing in real estate, you know I wish you luck and I hope you win.